Welcome to Taking Stock for the week ending 14th of July 2023, where this week Kien Trinh, our head of Stock Doctor Research, joins myself, Tim Lincoln, for another week of Taking Stock. And Kien, this is our end of financial year edition, so plenty to get through. And before we do so, how are you?
Oh, not too bad, Tim. I can't believe the year's already over, and we're already starting to look forward to this next reporting season, which should start in a few more weeks.
Yeah, well, 2023 was a bumpy year, and we'll get through plenty of detail around there, especially relative to our methodology and how we go about selecting stocks and managing portfolios. But before we do so, Kien, let's just read through our little disclaimer at the start. All of the information that we share today is of a general nature, and there should not be construed as personal advice. And all of the data, information, and performance charts that we also share are of an historical nature and therefore should not be relied upon as a guide for future performance. So let's get into it, Kien. And who would have thought the 2023 financial year would have been so prosperous for equity investors? Just incredible. With a plethora of macroeconomic data points suggesting global economies are headed for recession, there was no stopping global share markets as share prices powered ahead, with the All Ordinaries Accumulation Index here in Australia rising some 14.8%, while the US S&P 500 jumped 17.6%. Meanwhile, the US tech index, the NASDAQ, rallied 25%. Just incredible. Helped by market enthusiasm around the whole AI theme and related stocks.
Yeah, incredible, Tim. I mean, there were so many macroeconomic events that would have frightened investors, and some of these included, the steep spike in interest rates. You had Silicon Valley and also US banking crisis as well. You had the Credit Suisse collapse and geopolitical risks with Ukraine, Russia, and China as well. And this is why, separating the facts from the noise is so important, Tim. Don't let your emotions take charge and really focus on what you can control and understand really the quality of stocks in your portfolio. And irrespective of all that short-term volatility, history tells us that quality stocks are more likely to outperform over the longer term.
Yeah, such great advice, Kien. And yeah, so much went on last year, didn't it? And really, for the last few years, it's just been such an interesting period and so much to consider and get our heads around. But despite facing all the headwinds like rising interest rates, our star stocks managed to match the market return for the year, returning 14.8%, which is a terrific turnaround, and they significantly outperformed the Small Ordinaries Index that returned 8.5% for investors. Small cap stocks, though, have lagged the major benchmarks as investors moved towards the perceived safety of larger caps. I think that's they were the ones that really investors migrated to from that defensive element, which are more liquid and can be less volatile in environments that are uncertain. And with the cycle of interest rates expected to peak in the coming months, which is great, there appears to be light at the end of the tunnel for star growth stocks and growth style and quality growth style investing. But investing is about the long term, as you just mentioned, that's for sure. And as you can see with the chart on screen, over the last 28 financial years, our star growth stocks have only underperformed the market in 4 of those years, which is, a really compelling statistic, translating to a success rate of 86% and an average per annum outperformance of 9.2% over the All Ordinaries Index. Better still, there have only been 3 years that star growth stocks have generated negative returns. So just to emphasize the importance of staying true to a methodology that obviously works over the long term, Kien.
Yeah, definitely, Tim. And, meanwhile, this has also been a great year for income investors as well, with our star income stocks returning around 13.7%. And that's despite, as you said, Tim, rising interest rates. Rising interest rates can dampen the attractiveness of stocks within those high-yielding sectors like listed property, retail, and also utilities. And also pressure came from the banks in the second half of the year on the back of the US regional banking problem, together with the banks also experiencing a peak in their net interest margin cycle as well. And again, over the long term, that's what really matters. And in the last 11 years, our star income stocks, they've outperformed the market in 7 out of the last 11 years, with an average outperformance of around 3.3%. And this is, again, quite an incredible statistic, given that income stocks tend to be more defensive in nature, Tim, and hence usually underperform in rising markets.
Yeah, and I think too, Kien, it's great to see that there is that 3% outperformance, and you compound even that over the long term, and it obviously produces significant results for investors' portfolios. But it's also the above market yield that's obviously super attractive for investors that are in that income or preservation stage of investing, and they're relying on that income to fund their lifestyle. So yeah, great results again over the long term. Can't emphasize that enough. But given that quantitative investing is core to our investment process, it is also important for us to keep track of the performance of the various investment styles, because this allows us to analyze our own portfolios. Yield and small cap significantly underperformed the market, while quality stocks and momentum-based strategies perform well. But Kien, what do you mean by quality stocks, which is obviously a core component of our methodology?
Yes, Tim, and we've outlined this before, but these are companies, for instance, they have very high returns on equity, generating those returns for our investors, and also those with very strong earnings quality. So earnings quality is about having strong cash flows, that's consistent with your profits. And then, of course, you've got high profit margins as well, because profit margins are a reflection of the market positioning of that stock or that business. It was also interesting in that chart as well to see, Tim, that growth and value performed roughly on par last year. So we're starting to see growth start to re-emerge here.
Yeah, great. And it is all about cycles, isn't it? You just got to hang tough when the cycle's going against your style of investing. But as we saw on those earlier charts where we've had only, was it 4 years of underperformance for the star growth stocks and 4 for the star income, you've just got to have confidence that most of the styles will work the best. But when it does go against you, you can't knee-jerk and change. You just got to stay with it. But yeah, really good to see. And also, I've got to pump up our managed funds here in the business too, Kien, which really mirror our star stock portfolios, but where we manage portfolios for our investors instead of them necessarily DIYing, even though there's a lot of crossover between our stock doctor members and our fund investors. But it's, really proud of how they've performed this year as well. And despite the lack of appeal for growth stocks still, because they're still performing on par with value, as you've just said, our Lincoln managed funds performed exceptionally well. The Lincoln Australian Growth Fund returned 17.8% return for the year, while the Lincoln Australian Income Fund generated 14.1% return for the year for our investors. Meanwhile, the US funds shot the lights out. For those invested in our US funds, the Lincoln US Growth hedged and unhedged funds returned 20.3% and 30.7% respectively, significantly outperforming the broader benchmarks in the US. So yeah, great stuff. And thanks to you and your team for putting those stocks in front of us to invest in. Moving on to our financial health now, Kien. And with the new financial year upon us, we cannot become complacent. Complacency in the management of portfolios leads to neglect and obviously perennial underperformance if we become complacent. We've already started to see the impact of higher interest rates on retail stocks and as consumers begin to tighten their purse strings. And only this week, outdoor retailer KMD Brands, the company behind Kathmandu and Rip Curl, joined the ranks of Adairs, Harvey Norman and Domino's Pizza by downgrading earnings on the back of slowing sales growth. So we're starting to see interest rates really start to bite, Kien.
Yeah, that's right, Tim. And consistent with earlier downturns as well, we can expect that a decline in the discretionary spending will spill over into other industries, and that's going to lead to profit downgrades, job cuts, rising unemployment, and escalating corporate failures as well. And you can see here with the chart on screen, the proportion of unhealthy companies in the market is currently at around 77.8%, so still very high.
And moving higher, Kien, I think that's been about a 2% increase over the last year or two. So it's a really incredibly important barometer, even though it just moves in small amounts relative to that total percentage of companies that are unhealthy. But when you see it slowly start to tick up, it is a good barometer for an indication of the economic environment. So interesting stuff. And the trending corporate failures continue to ramp up in 2023. You can see with this chart on the screen, with the number of bankruptcies in financial 23 rising by 45% from a year earlier, which is a big increase, but something we've been warning our members about, for probably 2 or 3 years now. And within the listed space, we've recorded 19 corporate failures, a big increase from the 8 failures recorded in financial year 2022. Although the construction, hospitality, and retail industries have been in the spotlight, no industries are immune and range from healthcare, financials, manufacturing, and resources. So we've just got to be really vigilant in managing our portfolios and ideally avoiding any of those distressed, marginal, or early warning businesses that are at risk of corporate failure.
Yeah, that's quite a long list there, Tim, on screen. You can see so many different kind of companies from various sectors as well. And more recently, though, we observed the failure of Hills Limited, which is also on that list. And a lot of people would be familiar with this company because they manufactured the highly distinctive Hills clothesline, Tim.
Kien, they're actually the Hills hoist. So clotheslines, I think when people hear Hills hoist, they're from our childhood days when we used to swing around on the old clothesline. We've still got one here in our backyard. My wife Sarah loves a Hills hoist. So yeah, we used to hang on them and go around them, and they were a great source of entertainment in our backyards many, many years ago. But really sad to see that the original company has now failed.
I know, very solid clotheslines. They used to make them very solid those days, but not anymore, Tim. And despite their recent interim result reflecting profitability, and that was due to a once-off divestment within the business, those eagle-eyed investors and those using Stock Doctor would know that the underlying company was in a dangerous position.
Yeah, absolutely, Kien. And speaking about risks and opportunities, artificial intelligence, or AI, should remain a key theme for this financial year. Only a month ago, our senior portfolio manager, Matthew Schwartz, and equity analyst Dan Ortizi conducted a presentation outlining the key AI opportunities in both the US and Australian market. According to Bill Gates, the development of AI is as fundamental to technology as the creation of the personal computer and the internet and mobile phone. So really, really profound and a major change and advancement in technology. So it's going to play a massive role. We all know that, but that will present opportunities. However, we need to be careful, really, really careful. With all new emerging industries come risks. And there are signs that a bubble could be forming within this tech space, especially in the US market. And if we run a filter for AI opportunities in Stock Doctor, you can see that many AI-driven companies like BrainChip are unprofitable and in a distressed state of financial health. So a lot of specky stocks in this space right now, Kien.
Yes, that's right, Tim. And that's where Stock Doctor can help. Unfortunately, there are limited opportunities to invest in healthy AI businesses in Australia. However, outside of those immediate beneficiaries, there are high quality stocks that can benefit through what we call secondary revenue drivers. And these stocks are our star stocks, some of them like Pro Medicus, WiseTech, Telstra, and even Macquarie Group. They've got a division focusing on AI as well.
And I think we can throw Lincoln Indicators into that group too, can't we, Kien? Not that we're listed though. So unfortunately, members can't invest in us, but we're exploring ways to incorporate AI components into Stock Doctor and also in our testing environment. So yeah, really exciting stuff. And for those that want direct exposure with, you can do so via our US funds as we invest in quite a few AI related stocks, including Alphabet, Arista Networks, and also Adobe, who are really at the front end of incorporating AI technology into their products and services as well. And now to question of the week here, and with the start of the new financial year in full swing, a useful question for investors is, what's our view on the market outlook and how are we positioning our managed funds at the moment?
Yes, great question, Tim. And to explain this, I'm using the chart on screen, which compares the earnings growth expectations for financial year 23, which is gone, with financial year 24, and it's split into various different industries with our star growth stocks in yellow as well. But as you can see, the earnings growth expectations for the market, which is in dark blue here, and that's for this financial year, FY24, that's expected to be flat. But much of this is really weighed down, as you can see, by resources, which is in green, and the banks there as well, which are expected to post negative earnings growth for the year ahead. And growth across the industrials, though, and industrial stocks is expected to be quite strong at around 10%. And we believe this is where a lot of the opportunities lie. We're quite heavily weighted towards these industries. But also notice how the growth across our star growth stocks remains quite strong, in excess of 10% for the year ahead as well. However, with that said, though, if the economy slows significantly or even falls into a recession, we believe that that flat earnings environment may be too optimistic. And the facts are, we are in that environment with persistent core inflation, which remains quite high. And you've got rising interest rates, the lag effect of that, geopolitical turmoils and rising insolvency levels as well. And you've got the declining consumer and business confidence. So if you explore the previous recession cycles, and that you can see that with the chart on screen, you can see that corporate earnings per share declines 18 to 30% over those periods. So we're in a quite a vulnerable state at the moment.
Yeah, we sure are. It's again, we back to that point we made on complacency before. We've got to really stay incredibly vigilant and keep our eye on these things for sure. Hence, we believe that negative earnings revisions are likely to continue from here and that investors should tilt their exposures more defensively. And most importantly, focus on financially healthy businesses that have balance sheet strength to excel when others are vulnerable to failure. Really important. Our portfolios have got to contain those healthy, high-quality businesses, whether they be growth-orientated or income-orientated relative to your investment objectives. And in our view, and as the earlier chart suggests, we believe the shift towards quality investing is already underway, which is great. Tactically, I've positioned our funds, growth portfolios, in circa 30% cash at the moment. And our income portfolios, we have transitioned 25 to 30% of the portfolio in our holdings down the risk curve into fixed interest securities, which are generating attractive yields to maturity, but with the lower level of volatility associated with direct equities. Our tactical positioning will reduce our portfolio's downside risk in the event that we encounter an economic slowdown. We've already begun to see the net negative earnings revisions across the market. See the chart on screen with the earnings trend in black compared to the market in blue. And leading indicators such as PMI and manufacturing orders indicate that more downgrades are likely to materialize. And as a fundamentals first investment manager that we are, when the earnings are at risk, we'll use tools at our disposal to effectively manage the risk in our portfolios. And if the opportunity presents, we'll have the ammunition available to buy the stocks we like at discounts, especially when interest rates start to come down again. The words of Warren Buffett keep ringing in my ears. be fearful when others are greedy, and greedy when others are fearful. And with the markets roaring ahead in the past 12 months against all odds, perhaps it is pertinent to deeply respect those very wise words. Well, a bumper edition, Kien. I think it was a really good wrap on 2023 and a little bit of foresight into 2024. Would you agree?
Absolutely, Tim. It's been a wonderful year for investors, and I hope 2024, with all those risks, would be another one, especially for those growth and income stocks.
Yeah, and I think it is a great opportunity to be very tactical. Sure, as I said before, we've got to be vigilant. We've got to be prudent. We've just got to really manage our portfolios carefully around the quality to ensure we're not exposed to those companies that are at risk. And if we're positioned and we're really vigilant with all of that, then there could be opportunities ahead too, relative to when things really swing back hard to quality growth and quality income, which is exciting. So I hope you enjoyed this week's edition. Been great sitting down with you all. Take care and have a happy, healthy, and prosperous week.